In this video, I will walk through the application of project number 1 to Steel Dynamics Company. The first thing, if you notice, I've gone to the home page of the company, and it tells us, you can see it flashing around about their top priorities: safety, customer commitment. They talk about their partners. So we start to get a picture of the firm when we go here. Culture. So the first thing we're going to do is go to Investors, click on Investors, and this is going to come up, and it's going to give us all sorts of options. And the first thing we're going to do, since we're basing this on the actual computation based on the 10K, we click on SEC filings, and where it says filings, we want to look for a 10K annual report. Press search, and what you see is it comes up with the date and the form. So what we see here is you can take it in an HTML, PDF, Word, but we're going to take it in Excel. Okay, and it is going to actually download all of the information that you need. It's coming right up. Okay, so we enable editing, and the balance sheet is all here. We got consolidated balance sheets, statements of operations, so we have all of that. So we download it. Once you download it, what you want to do is, I brought it all over, I copied and pasted into the first tab of my worksheet. And you want to make sure they align, because sometimes these lines don't always line up, and sometimes they do. Notice I've gone from 13, 14, 15, 16, 17. I have a trend going this way. Why I do that is we can develop trends better that way, but then also in more advanced classes, we're actually going to go out and do a forecast from there. So for those of you that are taking financial statement analysis in the spring with me, we're going to take it from there. So this is sort of the fundamental. When we do financial statement analysis, we're going to review this stuff in the first session or two, but you'll be well prepared for that. Next thing I wanted to do was create an income statement. I had to summarize it. So if we go back over here and we go all the way down, here's their income statement, all sorts of stuff. But what I did is I put the key things I thought were important: sales, cost of goods sold, and gross profit. And see, the gross profit I expressed as both dollars and percent. I then said these are the categories I want, because as I'm analyzing a company, some of these things are going to help me understand what's going on. Okay, for example, profit sharing has gone up. But we can then see net income. Okay, I then common sized it, which is essentially just taking this, and if you look, all the formulas are built here for you. Okay, so you're sort of like, okay, you just get the data, as you can see how the data comes from somewhere. Okay, that's a calculation. So when I do a calculation, I do it right here. But it's the same calculation that's used all the way across. So this is the first requirement to do the income statement 5 ways, or 5 years. You can see there's 5 years. Common size. Notice how that all the decimals are set properly. We don't have a lot. We don't need 3, 4 decimal places out. The next challenge is to do a graph. So what I did is I looked at what I thought was important from above. Okay, so I looked at all of these and said, what's the most important to convey a picture? And I created a graph so that you can see what it is. And what you can see is that it's labeled, the data points are there, and we can see some trends. So that's what you need to do on the income statement. You need to do the same thing on the balance sheet. We come into the liquidity ratios. The first thing we're going to do is compute gross working capital. So these data all come from the data. So you're going to go back and bring them up: cash, accounts receivable, inventory, prepaid. That's going to give us gross working capital. Now, I put sales in here because I'm going to use it a little bit later. But remember, gross working capital is current assets used in operations, which does not include marketable securities. Okay? Net working capital is the difference between current assets and current liabilities. And again, they come right off your data. So one of the things is that if you make a mistake, you can correct it by actually going back to the data and making it. But notice how these, they're laid out. Okay. Net operating capital, that's operating current assets less operating current liabilities. These are the same because in this company, there's no marketable securities or anything like that. And I think the companies you're going to look at don't have anything there either, but I could be wrong. Then we go through the free cash flow. And this information here cash flow comes from, if you're watching, we're just going to put that right in here. Comes from cash flow statement. Okay. Capital expenditures also comes from the cash flow statement. So this comes down, if you look, that comes down there. Okay, interest, assume a tax rate of 30. But this one here, so this is a computation. Notice it's a computation, so whatever the tax rate is. So this is a computation. Interest expense, that comes from the income statement. And less capital expenditures comes from the cash flow statement. Okay? And all of these numbers here come from the cash flow statement. And the totals are compute calculations. We then go through the cash conversion cycle, and the best thing to do this is, I think, is if you trace through where these came from, and then again, I put them in a table. I did the calculation, each one, and they all, I didn't create anything, or I didn't hand input. Everything comes from the data. Then I looked at graphs and said, how can I really display this in a graphic form? So here's the cash conversion cycle in a graphic form. You can see it's getting better. What I did is I tried to break out this cycle by the component parts. So what I'm trying to do is visualize what's going on. And I think as you move forward and you put these into PowerPoint and visualize things, it means something, because we're trying to say what's happening over a period of time. Okay? And if we look at the inventory conversion cycle, what we can see is if we're going back to 13 and 14, it took 72, 80, 80, 75 days, 65, 59, 58. So inventory is turning faster, which is more efficiency. And that's what we're looking for. And then you can eliminate the outliers. Okay? When we essentially look at what's going on with accounts payable, it's no big deal. Okay? And when we look at accounts receivable, but the big thing that's driving it is lower. Working capital's going up, staying good level of working capital, but we can also see where the strength is. So you can come down here. This does the current ratios and everything. Now, when we look at that, this all comes from the balance sheet that I had over here, 10K data. You just bring it on in. And this is talking about liquidity. Does the company have cash? Some of these are meaningful and others aren't. So your challenge is to come through and say, what is really meaningful here? Is the current ratio meaningful? Probably not. I mean, we got to look at it within the context of what working capital we have. How are they turning it? It's a good number. We don't need to restate that. When we're looking at liquidity, we can conclude certain things from this. That's liquidity. We then move over to the net income statement, where it goes through and you compute it, and then you're going to go back and make observations of what is going on. So that's a brief review of steel dynamics. Now we saw this. This is how the Excel part works. Okay, so you got to go and make the assumptions around that. If you have any questions, please let me know.